All right. So I'm going to be covering everything once again with I believe cleaner chart, cleaner explanation, and I'm gonna run everything down. It's gonna take about an hour or so. So if you're ready, let's get to it. So I'm explaining forex because forex goes overall. Once you understand forex, it goes over everything, right? So the forex market is quoted in pairs. What I mean by that is everything is in a pair. Whether it's the forex market, fucking crypto market, everything, futures, indices, commodities, whatever it is, it's a pair, right? Um, it's about how much it costs to buy one unit using a quote uh, currency. Example, right now we're using Euro USD. The base currency is the euro, quote currency is the US dollar. The value is 1.17, right? A dollar and 17 with 12 pips. All right. Pip is the fourth decimal point. An example would be the 2 right here, right? The 2 is the fourth decimal. So if it goes up 1 pip, then it would be, a dollar 17 with 13 pips, right? So there's different sizes for positions, right? So there's different lot sizes, and there's different names for the lots, right? So we have the 0.01 lot, which is called a micro. Every single pip difference is 10 cents, right? And how much it would cost for you to be able to afford one micro lot is $1,171 for the Euro USD, right? So we have the 10 or the point 10 lots, which is a mini. So each pip is a dollar up and down, right? Dollar up and down. $1. Yes, sir. $11,712 is how much one mini lot would be, right? We have the standard, the big boy, 1.00, right? Each pip up and down is $10. $117,120 for this example, right? One standard lot. 1,000 of the currency is one micro, 10,000 of the currency is one mini, 100,000 of the currency is standard lot, right? Got that figured out? Going over to the basics. Right, let's go here. Uptrend, downtrend, consolidation. Three different ways the market can move. Up, down, sideways, right? Retracement. What happens in between the trend, right? If it goes up, it has to go down to continue going up. If it goes down, it has to go up to continue going down, right? So we know what retracements are: high, low, higher low, lower low, higher high. So now that we know what this is, we can identify a uptrend, we can identify a low trend or a downtrend. So yeah, there we go. Candles. What it is, it's all the price action shoved into a visual uh data, right? So you're able to see the numbers instead of having to read the numbers. If that makes any sense. Um, the wicks, those skinny little twigs, right? Not the rectangle boxes, but the skinny little twigs. That is where price has been. You know, price was at one point there. We have the bearish candle, which is the red one. It opens there. The body is, the price it holds. Close is the time it was done forming. So this candle is done forming and now shows us where price has been, where it opened, where it closed, right? And where price has been. Because it opened at the top, closed at the bottom, it's bearish. It went down. We have a bullish candle. It opens after, right next to the one that closed, right? So now we have an open candle. Goes down for a bit, goes back up, closes after going back down. We have a bullish candle, right? Same exact thing. Shows us what happened during that specific time. Every candle represents the time frame slash what happened during that specific time, meaning in smaller time frames, you're going to have a more detailed price action, as in a more detailed picture of what happened. Whereas if you go to the higher time frame, you're going to see a more overall slash everything's going to be accumulated into, a bigger candle. So instead of seeing, a bigger or a smaller, more detailed visual, you're gonna see one big fat juicy candle just showing you what that price action was overall, right? So the higher the time frame, the more respect slash importance it has, the price has. All right. So we have liquidity sweep, liquidity. We have break structures, and I'll explain it. So we have liquidity. What is liquidity? Literally orders waiting to be filled. Pending orders, limit orders, whatever it is. It's orders waiting to be filled, right? And liquidity sweeps is when price goes into filling the orders that haven't been filled yet, right? And then because of that, it picks up momentum to go to the opposite direction, right? So liquidity sweeps are an indicator of a reversal. What do I mean by that? Changes direction, right? Bam. BOS is an indicator to change the order flow slash trend. What I mean by BOS, break a structure. What I mean by order flow, I mean trend. It's just a fancy way of saying the way the market is moving. So the market is greedy and will always chase liquidity. What do I mean by liquidity? Orders waiting to be filled. So it's always chasing money. The market wants as much money as possible. So what can you how do you know when a break structure happens? A break structure happens whenever a candle closes above the previous wick. So right here, we have a break structure. Bam. Break structure upwards, goes up, sweeps liquidity, comes back down, candle closes past the wick, break structure downwards. What happened? Continues going down. Bam. There we go. Now you understand breaker structure, liquidity sweeps, what liquidity is, and what happens after a liquidity sweep. Nice. All right. Imbalances, FEGs slash IFEGs, fair value gaps versus inverse fair value gaps. If respected, it'll continue its order flow. If disrespected, order flow changes. When the market moves too fast, a imbalance is created. The orders that were missed slash unfilled. What happens? Literally, price goes and misses a bunch of orders. Price is greedy, so it comes back and fills them, right? So it's just the gap in between the candle wicks, right? So right here, price moved too fast, missed all these orders, came back because it's a greedy son of a, and it comes and taps those orders and then continues going its direction, right? Same thing here. Comes, goes up too fast, misses these orders, comes back, taps it in. We're good, right? Right here, same thing, right? So as long as the body doesn't close past the imbalance, it's good, because this is not the body. Even if it closed right here, even if it closed past, it's still respected because it's not the body, right? As long as the wick goes anywhere but the body doesn't close past it, we're fine, right? Respects it, so it continues going its direction. Respects it, so it continues going direction. What happens here? It closes way past the imbalance, goes down. Closes way past the imbalance, goes up. There we go. Now we understand imbalances, right? And fair value gaps and risk fair value gaps, to be specific, you now understand it. Nice. We go into order blocks and breaker blocks. They act just like imbalances, but they can be very volatile if disrespected. Or vice versa. If respected, they can be also volatile. So it's good either way. I like volatility. So to me, if it's moving, I'm moving, right? So it also works best if paired with the mouse. So what I mean by that, everything you're learning right now is going to be working better with something else. What I would say is if you don't have two or more, then it's not worth it. Preferably three. You have to have three of these things I'm telling you about for you to be like, oh, okay, I'm willing to do this. If you only have two, then it's a risk. It's on you. Chances are it's literally a 50-50. There's only two. If there's not, in my eyes, it's not worth it if it's not a 1-to-3 ratio. I'm just not taking it. So it's basically price accumulation, getting tapped into, and then respected to continue going the opposite direction. Price, getting tapped into, and then respected, continue the direction. All right. Equilibrium. This will help you with imbalances, for value gaps, and order blocks, or imbalances and order blocks. This will help you because you can use equilibrium along with them. Right. Here's an example. We have, okay, so what is equilibrium first? It's the discount price. It's the 50% margin. It's where big money sells. You know, you have banks and all these big money buying and selling, but they always want to save as much money as possible. So they wait for the right time, as in they wait for the right discount to be able to sell everything they have or buy everything they have, right? So we have Here's a good little example. We have breaker block, imbalance, discount zone, BOS down, continues going down, target, lower liquidity. Bam. Just like that. We have it here too. Liquidity sweep, imbalance, breaker structure, continues going down. We have a lower high. We're like basically a confirmation. We're like, okay, let's enter. Where we wait for confirmation. Bam. Enter. Bam. We're good. Just like that. Beautiful trade. So that's all it is, right? All right. So reversals. What is a reversal? Liquidity sweep. When a liquidity sweep happens, chances are price is going to reverse the opposite direction. Confirmation. What do I mean by that? When you have a breaker structure, inverse rally gap, or a fair rally gap, you want to have it and see it so you can basically confirm your bias, right? You have a bias. It's either going up or down. You have a bias, right? Continuation. Fair value gaps, inverse fair value gaps, order blocks, breaker blocks, equilibrium. You want to have a continuation. You want to have a reason your trade is going the right direction, right? So we have important targets: 1 hour, 4 hour liquidity, right? Every single candle is based on time, right? Every single candle is based on time, right? If you go, you want to find as much liquidity as possible. So the higher the time frame, like I said before, the more important it is. So you want to look at the higher time frames. You don't want to go into the fucking yearly and try to find a trade, because yeah, you can, but you're going to be sitting there for a long time. So you want to have it reasonable, right? So you're going to look into the 1 hour to 4 hour time frame, see liquidity. If you see any good area liquidity, you see good market movement, you see it's good, nice, that's a target, right? Wait for price to hit the high level, the high key level / important target. Wait for it to go to where you want it to go, right? You change into a smaller time frame, whether it's the 5, 10, 15, 30, 35 minute, whatever helps you see it better. Then you just wait for the confirmation, right? Breaker structure, inverse fair value gap, equilibrium. You wait for the confirmation, right? And then you go into the smaller time frame, whether it's the 1, 5, 10 minute. You wait for continuation, right? You wait after all the other ones. You wait for either fair value gap being respected, order block being respected, breaker block being respected, equilibrium being respected. After you see that, you go back to the 1 minute, 5 minute, whatever, just the smaller time frame to be more specific, right? More detailed. So then you go and you wait for a confirmation there. You see breaker structure, inverse value gap, order block, breaker block, equilibrium. As long as it's confirming your bias, you're fine, right? I'm not sure if I said confirmation for the previous one. The previous one was continuation, with the 1, 5, 10 minutes, whatever. Point is, right? You wait for a confirmation, you see a continuation, then you go for another confirmation. After that, you enter your trade, right? You put your stop loss where your trade is invalid. You should have anywhere between 1 to 3 TPs, preferably 3, right? But you don't always have to have 3. Sometimes you'll only be able to have 2, just the way the market is moving, right? So let's see what I said here. Have 2 TPs, one set at the highest reasonable keyframe / target, and one at 75% of that, or at 25% of that, or all 3, which I like to do all 3, right? It's allowing me to basically guarantee myself money, because if you wait for too long, you never take profit. It might reject off of something, and you might not fully reach that 100% target. Whereas if you take 25% or 25% and 75%, at least you took, you're fully out of your position, even if it didn't fully hit your target. So that's a good thing about it. Or you can set all 3, whether it's a break even at 25%, and then a full target at the top, the furthest wherever you decide the target is. Stop losses, take profits. So basically, shorting means you're betting / selling against the market. You're making money if price goes down, right? You're longing, you're buying low so you can sell high. You're making price You're making money as price goes higher. And your stop loss is at the spot where if it goes past, the trade is invalid. So what do I mean by that? Is exactly what I was talking about. Imbalances, breaker blocks, order blocks. You know, if it gets disrespected, it's gonna go the opposite direction. So what you want to do, you want to have it at the spot where if it goes past that, you know, it's basically just guaranteed to continue going that direction, which is not what you want, right? So that's why you want to save as much money as possible. So instead of having your stop loss all the way up here, because you're like, oh, if it goes past there, then yeah, it's gonna continue going that direction. Nah, just save as much money as possible, right? Have a guaranteed spot. Well, it's not, nothing's guaranteed, but like as close to valid as possible, right? So we have a, let's, play pretend. Chances are, looking at this right here, there probably is something like this, right? So I'm gonna explain what could possibly be right here. So we have an imbalance, breaker block, we have a equilibrium respect, and we have a continuation on downtrend. We have a lower high right here. We have a lower low right here. What happens? Lower high right here respects the order block, equilibrium, imbalance. It continues going down. We target this low, if not even lower on a higher time frame. Bam, just like that, we got a winning trade. Nice. That's all it is. That's all it is, guys. And yeah, uh, hope you guys learned a lot. All you got to do now is study. GG's.